Hi, everyone. It's AJ with North Capital Mortgage, and today we are talking about the age-old question in mortgage finance: should I pay points? So there's been a lot of discussion on whether paying points makes sense for people, and it really depends on everyone's own individual situation. But today we're going to look at some examples and talk about how paying points may or may not be helpful to you. So what is a point? It's really entitled discount point. It is a fee equal to 1% of the loan amount. You pay that fee up front during closing, and it will in turn lower your interest rate by a certain level. It's also known as a buydown point. Why should we pay points? Well, firstly, it's going to lower your monthly payment. If you're going to pay a fee to lower your interest rate, therefore your monthly payment will be a little bit lower. Secondly, it's going to give you a pretty nice savings over the long term in the amount of interest that you pay, right? Lower interest rate over an extended period of time, interest savings you will acquire, okay? So this is going to be good for those who are staying in their loan for an extended period of time, and it is not going to be good for those people who are not going to be staying in that loan for a long period of time. If you feel that you're going to exit your mortgage loan after a year or two, paying buy down points may not be beneficial for you, okay? So what we have here is a rate stack or a rate sheet, if you will. And what this tells us is it gives us some examples of interest rates, what those monthly payments are. By the way, this is a $740,000 loan amount example. You will have points associated to lower or actually increase your interest rate, and the cost and the credit. Now, we're talking about buy down points, and sometimes people are unaware that you can actually increase your rate and receive points from the bank. So that is correct. If your par rate, and in this case that's 6.25, and par rate is the term that people utilize when they're talking about the interest rate that has no cost or no credit or closest to par. In this scenario, 6.25 is the closest to par. There is no interest rate offered here that has zero cost or zero credit. So if you increase your interest rate, let's say in this situation to 6.625, the bank will actually give you a little over $7,000 towards your closing costs. And in the long term, on this loan, that's not going to be beneficial for you because the extra cost that you pay every month in that increased interest rate will outweigh the benefit that you receive after a certain period of time. But if you're looking at buy downs, okay, and you're going to be in this loan for an extended period of time, this could be beneficial to you. Okay, so here we have an example of this rate stack or this rate sheet, and you can see if you want to go from 6.25, which is closest to par, down to, let's say, 5.875, that's going to cost you a little over $8,000 in cost, and your monthly payment difference is going to be about $178 or so. Let's take a look at an example to see how we can determine whether that buy down is beneficial to us or not. So in the break-even analysis, 5.875 is going to give you a monthly savings of $178 versus 6.25, which is closest to par. The cost is $74.81. So closest to par is going to cost you $555, and going down to 5.875 is going to cost you a little over $8,000. That difference is just under $7,500. You do the break-even calculation, which is simply the total cost divided by the monthly savings, 41.8 months. So if you're going to stay in this loan for longer than 42 months, that is when you will start to save $178 a month in hard savings, okay? So if you're going to potentially refinance or sell the property or get out of this loan sooner than that, then doing a buy down would not make sense. Okay, so this is just a very basic example of how to calculate the benefit of buy down options. Some factors to consider: time horizon. Again, how long are you going to keep the loan? The longer you anticipate keeping the loan, the more beneficial that buy down will be for you. Cash on hand. Do you have enough cash to pay for this? Now, if you're doing a refinance, you can also utilize funds from your equity to finance that. But then remember, you're going to be paying interest on that fee, right? So you have to consider that in your break-even analysis. Future rate expectations. If you believe we are in a declining interest rate market, it may not make sense to pay buy down fees, because at 6 months or a year and a half from now, if rates are significantly lower, it would be just cheaper to refinance than paying buy down fees many times. And then also tax consideration, right? So buy down points may actually be tax deductible. Obviously, consult with your CPA. I'm not a tax expert, but that is something that can be considered when you're making that decision. Okay, so a lot of variables. This is basically what points are and how they work. If you have any questions, give me a call. We can go through any scenarios. We can price out some different options for you. And I'd love to hear from you. Any questions, 714-624-5151, or you can email me, AJ with North Capital Mortgage. I appreciate your time.